I'm Laura Williams, and this is PwC's Tax Insights in Brief. On July 17th, Treasury and the IRS released final regulations under Section 367B, providing guidance on the taxation of cross-border triangular reorganizations and related transactions. The regulations finalize, without substantive change, proposed regulations that were published on October 6, 2023. Recall that the proposed regulations limited the application of the excess asset basis rules that were described in Notice 2016-73. Those rules were adopted in the final regulations without change. One minor change was made to the facts in Example 3, an example applying the anti-abuse rule from the 2011 final 367B regulations. Treasury and the IRS removed language that suggested that the 245 Cap A holding period was not met under the example's facts. In the preamble, Treasury and the IRS responded to a comment that the addition of new examples of the application of the anti-abuse rule could be viewed as an expansion of the 2011 regulations, and therefore should be eliminated or prospectively applied. But Treasury and the IRS declined to exclude or modify the examples. The final regulations also clarified the definition of a foreign subsidiary for purposes of the excess asset basis rules. In the regulations, a foreign subsidiary is defined by reference to Section 1248C2B, which describes a 10% ownership threshold, taking into account the constructive ownership rules in Section 958B. Taxpayers should consider the application of the final regulations on past and future transactions. And taxpayers should also analyze the excess asset basis rules under the limited scope, which was first presented in the proposed regulations and are fully adopted in the final regulations. And while this change from the 2016 notice is generally taxpayer favorable, the final rule includes a principal purpose test that taxpayers must analyze carefully. For more details, read our insight. Thanks for watching. This has been PwC's Tax Insights in Brief.